Good morning.
Morning, sir.
Good morning.
Okay, I suppose that you had a good weekend and you're ready for us to begin our week. So the last time we met, you were discussing on working capital, which I think we did complete. And correct me if that's not the case. I think we were discussing on the different investment appraisal. We are discussing on the different working capital investment policy and the working capital financing policies. We discussed all that, isn't it? That's the last class that we made. Brian.
Yes.
We discussed the last time we met.
Yeah, we finished on working capital.
Okay, great. Okay. So today, as we discuss, we begin with a new topic here on investment appraisal. Okay, investment decision making. Okay, our next core topic. Okay, I think I had mentioned earlier on. Okay, that working capital is one of the topics that, of course, we expect to be there in the exam. Okay, and with the key concentration more towards how to manage inventory and how to manage receivable. So expect to have questions in your exam. Okay, on this area. Okay, on this area. So expect that there'll be a question from this area for sure. Okay. This is another next key topic. Okay, we'll refer to as investment decision making. Okay, investment decision making. Okay. Now, in this topic, what we want to discuss is that as a company, you may want, or rather, if you remember, we discussed is that in financial management, there are three core decisions that we do make. We have financial decision, we have investment decision, and you have the dividend decision. Okay, investment, financing, and the dividend. Okay, so let's now begin on investment decision. Okay. Now, on the investment decision, okay, we want to determine where should the company put its money in, okay, which among the different competing long-term projects, okay, should we expand our operation, okay, should we buy a new machine, okay, should we expand our market, should we expand from market A to market B, okay. Now, these are long-term decisions that as a company you ought to make, okay. So the key question shall be attempted to answer here in this particular topic is what are the different appraisal methods that you can use? Okay, what are the different investment appraisal methods you can use? Okay, of course, discussing the advantages, disadvantages of each one of them. Okay, we getting to know. Okay, how do we make what the criteria of us making the decision, okay? How, if for example, you're going to be using, let's say, the payback period method, okay, which we shall discuss it alone, okay? Payback period simply, how long does the project take to pay back the money that you have invested in it, okay? If you did invest 1 million, okay, how long do we take to recoup back the 1 million, okay? So generally, how do we determine whether this is a good project or not a good project, okay? Based on the payback, okay? For example, the company can say that we only accept project that has a payback period of 2 years. So in case you have a project that has a payback of more than 2 years, does it have 3 years, then of course we reject the project because it is the repayment period, okay, the repayment period in quote is beyond the target of 2 years, okay. So this we shall be discussing this method, okay. We discuss what are the different appraisal methods that we can use, okay, as a company, okay. As well as what are the different, okay, how do we determine the value, okay, how do we appraise in quote, okay, that particular project using the payback period method, using the different appraisal methods, okay. That's what we're discussing in this particular topic, okay. That's the core concentration in the topic. Of course, as I mentioned, this is a core topic. Of course, therefore, we do expect, okay, that there will be a question your examiner will be asking from this topic, okay. That's a must, okay. Working capital, I think you already mentioned about that. And now on investment appraisal is another topic which we expect that your examiner will be asking questions from, okay. So before you begin this topic, okay, I want us to just do a simple summary of what we shall be doing in this topic, okay. So as I mentioned, the key questions we shall be attempting to answer in this topic is what are the different appraisal methods can have, okay? Now the appraisal methods can have, okay, the appraisal method can have, okay, we can classify them into main category, okay? We have first is called the non-discounted, okay, non-discounted, okay, cash flow techniques, okay, cash flow techniques or methods, and you have the discounted cash flow techniques, discounted, okay, cash flow, okay, techniques. Now, the key distinction between these two methods, okay, is as the name is suggesting here. One is using cash flow are discounted, okay, and then the cash flow are not discounted. So here in this example, in this category, the cash flows, when it comes to the appraisal of the project, we don't discount the cash flow. We don't need to determine the present values of cash flow, okay. In the next category, the discount cash flow techniques, okay, the cash flows, when it comes to the appraisal, all the cash flows that we use it need to be first be discounted, okay. Well, that means therefore we need to get the present values of those cash flows. We need to get the present values of those cash flows, okay. We call them as the discounted cash flow techniques, okay. Now, in the case of the non-discounted, okay, as we've just mentioned, okay, we don't need to discount the cash flows. We don't need to determine the present value of the cash flows, okay. And the two methods we can use here, okay. They can first call the payback period method, and here the other method called the accounting rate of return, okay. The accounting, okay, rate of return, accounting rate of return, okay. Now, what's the difference here? The payback period method, okay, as I had mentioned, it's how long do you take, okay, how long does the project takes to pay back all the initial capital, okay? You spent 1 million in a project, okay? How long do you take as a company to get that 1 million from the project based on the cash flow that the project will be generating, okay? How long does it take, okay, for you to get back, to recoup back all the amount that you spent on the investment, okay? Referred as the payback period method. Then you have the accounting of return, also referred to as the return on capital employed. Okay, return on capital employed. Now, in this method, what we want to determine is that is, as the name is suggesting, this is a better way of trying to explain it, using a return on capital employed. Okay, what we want to compare, okay, we want to make a comparison. We want to make a comparison that's between, for every dollar of initial investment, okay, for every dollar of initial investment, how much profit has it been converted into, okay? For every dollar of initial investment, how much profit has it been converted into, okay? So it seems like it's given us, for example, the easiest formula to use, okay, is equal to profit, average profit, given us the average profit and over the life of the project. Okay, we divide by the average cost of investment, average investment cost. Okay, average investment cost. Okay, of course we express as a percent. Okay, we express a percent. Okay, so it's simply, it's for every dollar of initial investment, for every dollar that we spent in this particular project, okay, how much profit has it been able to make? Okay, definitely the higher the return on capital employed, the more valuable that project is to the company. Okay. So here, don't forget you're using profits here, okay? If anything, this is the only method that uses profit when it comes to the evaluation. All the other method uses cash flow, okay? The other method uses cash flow, okay? But this method uses profit. So this is the only method that uses profit when it comes to the evaluation of the projects, okay? Now, to us, the discounted cash flow technique, as you mentioned, we need to first discount the cash flows, okay? We need first to get the present value, okay? If you're going to get money, let's say 3 years from now, okay, so here we have year 2023, okay, and now we're in 2020, okay. So in case you're going to get, let's say, cash of, let's say, $10 million in the 3 years time, discount it back to year zero, okay. Get what's the current value of this 10 million. Maybe it is equal to, let's say 8.2 million, okay, in current value term, okay. So all the cash flow, okay, from 2020 today all the way to infinity, all the way to the nth year, you discount them back to year zero, get the present value of all those cash flows. Once you have the present value of those cash flows as a today's term, okay, now you can now be able to appraise. For example, you can use the method called the NPV, okay. So the first method called the net present value, NPV, net present, okay, value method, okay, NPV method. Where here we make a comparison with time, for example, Okay, what is the sum of the cash flows? What is the sum of the present value of cash flows from the today all the way to the end of the year? Discount them all back to year zero. Okay, you get the sum of those present value. Okay, get the sum of the present value of those cash flows. You compare how much money have you spent today. Okay, we spent, let's say, 30 million. Okay, as the initial cost of the project. Therefore, NPV net is the sum of those present value cash flows less the amount that we spent. Okay, less the initial cost. Okay, and again, therefore, the NPV, the net. Okay, present value. Okay. Simply, what's the excess, okay, of the amount that you're going to be earning from what you spent, okay, or the excess of cash flows in present value terms of what you spent, okay, of what you spent was what you're going to be receiving. What's the excess, okay, what's the way above that, okay, because then use of the net present value, okay. You can also use the use of the internal rate of return, IRR. Now, in this method, the internal rate of return, okay, IRR, okay, we need to observe, okay, it's simply when it comes to discounting, okay, when it comes to discounting the cash flows from 2023 to year zero, from the end of the year to year zero, we normally discount at a given rate, okay. With sometimes in simplest term, the discount can be the interest that the holders want. Okay, if you go to the bank, okay, you borrow 1 million, okay. Don't forget the bank will be charging an interest cost, for example, of 10%. Okay, so if you want to determine, therefore, the sum of maybe the amount you pay to the bank, we discount at the 10%. Okay, the interest rate. Okay, so generally all cash flows, okay, to be received into the future, we discount at a given rate back to year zero. Okay, we discount at a given rate back to year zero. So if, for instance, the discount rate here, or let's say the case of the cost of interest here is 10%, okay, you discount 10 million by 3 years back to today, okay. Therefore, for instance, okay, be 10 million, okay. This is value at year 3, okay, is the current value. Let me call this with the present value, okay, 1 plus the discount rate, okay, the power of 3, okay, because this is 3 years from now. This is the current value today, okay, and the interest we required is R%, okay. So don't forget, when it comes to get the present value, we might discount at a given rate. Okay. Here, for instance, okay, this is 10%. For instance, this is 10%. Just to give an example, 0.1. Okay. Therefore, the present value, we will have 10 million divided by 1.1 to the power of 3. Okay, to give us maybe 77 million. Maybe I don't know, maybe 7.5 million. Example. Okay. Therefore, we discount back to year zero at a given rate to get the present value. Okay, which means therefore, okay, IRR here being the internal rate of return as an appraisal method, okay, the IRR here, okay. If we discount, okay, if we discount the cash flows of the project, okay, the 10 million, okay, all the cash flow all the way to the end here, if we discount them at a given rate, okay, and this rate is going to give us here the sum of present value, okay, the sum present value cash flow to be equal to the initial investment cost, the sum to be equal to the initial investment cost, okay. Okay, the sum to be equal to the initial investment cost in such a way that the NPV is equal to 0. Okay, then therefore that rate, okay, this rate here we discounted it at, okay, this rate here, okay, is therefore the IRR. Okay, that's at IRR. Okay, we know say that the NPV is always equal to 0. In short, the sum of present value of cash flows, okay, to be earned over the life of the project is equal to the initial investment cost, the initial cost. Okay, to be equal to the initial cost. Okay, but the IRR. Okay, now don't get this IRR. Okay, for example, you want to determine should we invest in a project based on IRR or not. Don't forget, IRR is a return measure, is a return. Okay, so we compare with what does the provider of capital expect. If the IRR is, let's say, 13% of the project, we compare with the cost of capital. Whoever is giving company the finance to invest in this project, what return do they want? They want 10%. And it's a good investment. Yes, it is a good investment because the cost is 10%. The return is 13% on the minimum. Therefore, this is a good investment. Okay. Therefore, the company should go ahead and invest in this project. Okay. And that's the use of the internal rate of return. The other method, okay, is called the use of the discounted payback period. Okay, the use of discounted payback period. Okay, what's happening? Okay, the use of discounted payback period. Okay, discounted payback period. Okay, now in this case, the discount payback period. Okay, simply how long does it take, okay, to recoup back the money? But now, okay, it is on discounted basis, okay. If you compare this method, okay, which was non-discounted, we never did discount the cash flows to year zeros values, okay. But now in the case of discounted payback period, we need to discount all the cash flows into year zeros value, okay. So in short, like the way we did, okay, the question I've just labbed off there, okay. So discount every cash flows, okay, back to year zero. You determine how long do you take as a company to get back your 10 million, to get back your 1 million, your initial investment cost based on those present values, okay? That refer to as the use of discounted payback period, okay? Those are the 5 methods which shall be discussing in this topic, okay? All the way from the payback period to the discounted payback period, okay? And once we answer those 5 methods, once we appraise investment based on those 5 methods, then we shall be done with the topic, actually. Okay. Clear?
Yes.
Okay, great. Okay. By the way, okay, maybe just make a mention. As I had mentioned, don't forget, all these methods shall be discussing. They are all based on cash flows, okay? They're all based on cash flows. They're all cash flow based, okay? Which imply, therefore, okay, when it comes to getting the value, whether payback period or whether the use of NPV, we need to determine the cash flows to be earned from the investment. Okay, the only method, as I mentioned, that doesn't use present cash flows is the accounting return, which uses profit. I think I mentioned that already. Uses profit. Okay. But imply, therefore, we need to quantify the amount of cash flows that we earned from an investment. Okay, we need to quantify how much cash is going to be earned by the company every year for the next, for example, N years. Okay, so we need to determine therefore the cash flow. So if anything, by the way, the key part where you may make a mistake, okay, and of course where there's more marks, okay, is getting the cash flow from the investment. Okay, not to have to get the NPV, to get IRR. Those are easy. Okay, they're easy calculations. But to get the cash flow, okay, is where we need to spend more time, and that's where we shall be spending more time in quantifying the cash flow to be earned by the company every year over the life of the project. Okay, that's where we shall be spending more time. Okay. Great. So that's why, therefore, I'll pay more attention when it comes to getting the cash flow, because as I mentioned, this is where the marks are. Anyway, let's begin. Now, when it comes to expenditures, okay, don't forget you can have two main types of expenditure. We have revenue and you can have capital expenditure. Revenue is what you incur to run the company affairs on day-to-day basis. Okay, paying for your paying for rent. Okay, expenditures you incur to pay for your employees. Okay, so those are the normal expenditures. In quote, the normal expenditures you incur in order to run the day-to-day operations. Of course, your accountants. Okay, you know that already. You expense them in the company P&L. Okay, so in case you be revenue expenditures incurred during the year, okay, you expense them, okay, at the end of the year, okay, to the profit and loss account, okay, which I think you have done that in the past, okay. So therefore, all revenue expenditures, you expense them to the P&L as expenses, okay. And of course, therefore, they are called period cost, okay, because they incurred over a given period, okay, they are called period cost, okay. In the case of the capital expenditures, don't forget these are expenditures you incur, okay, towards long-term investments, okay, okay, purchase of machines, purchase of land, purchase of property, okay, expansion of a project the company will be having, okay. So at the end of the day, these are going to be acquisition incurred in the acquisition of long-term assets, acquisition of non-current assets, okay. And definitely, therefore, our main topic is more towards the capital expenditures, okay. Is more towards the capital expenditures as opposed to revenue expenditure. Okay? And if anything, when it comes to the appraisal, when it comes to determine the value, we determine the value of capital projects, not these revenue expenditures. Okay, we don't include the company doesn't sit down and try to determine if these are good investment or not. Okay, to pay employee or not. That's not about. That's not an investment per se. Okay, so we appraisal only applies to capital projects. Okay, investment appraisal only applies to capital projects, not revenue expenditures. Okay. As I mentioned, for the case of revenue expenditure, don't forget we are going to therefore expense them in the income statement for the time period when they are incurred. Okay. For the case of the capital expenditure, we don't expense them. If anything, you capitalize them. Okay. Okay. So if, for example, okay, we have a case of, okay, I think you've done accounting for complex assets, okay, for example, okay, aircraft, okay, where we have some parts that depreciate at a given rate, okay, other parts are different at a different rate altogether, okay. If, for instance, you gain we incurring expenditure, let's say KQ, okay, they replace the body of the engines, okay, the aircraft, okay, they purchase a new body, okay. Don't forget that new body might not, if it is going to increase the useful life of the aircraft, okay, then that is going to be capitalized as a capital expenditure. If it is going to be increasing, okay, what we call the production capacity of the particular asset, then we need to capitalize it. If it is only going to is meant to sustain, okay, if the life of aircraft was meant to be 30 years, okay, you install a new body to maintain to maintain the life of that years, then that's essentially was a revenue expenditure, okay, to revenue expenditure, okay. So if it is about maintaining, okay, it is about maintaining the earning capacity of the machine, then that expenditure is meant therefore to be expense, okay. If it's about improving, okay, I'm not sure whether I've mentioned that. If it is meant to improve, okay, if it is meant to improve the earning capacity, okay, of the particular asset, then we need to capitalize it, because definitely it needs therefore to be appraised, okay. If you're going to be if this body, okay, you want to purchase of this aircraft, okay, is meant to increase the life of the aircraft from 30 to 40 years, okay, then we need to sit down and appraise the particular expenditure. You need appraisal, okay, determining how much value is it going to create for the company. Should we incur this expense or not, okay. That's about improving the earning capacity of a particular machine. Okay. So as I mentioned, our topic is more towards the capital expenditure, not revenue expenditure. But it's worth enough, the key differences. Okay. No, don't forget, main concentration is more towards the public listed company. Okay, PLC. Okay, public listed company. Okay. Which imply therefore these are commercial company, these are commercial entities which are there to make money. Okay, they are there to make money on behalf of the owners. Okay, they are there to make money on behalf of the owners. Okay, what they have mean therefore is that every project need to be evaluated on commercial terms. Okay, evaluation need to be done on commercial terms. Okay, as opposed to the NGOs, as opposed to the NFPs. Okay, the not-for-profit organization. Okay, which essentially projects are not evaluated, okay, on commercial terms. Okay, for instance, in cases about US aid, okay, they don't evaluate how much was the NPV, okay, because that's not the main purpose. Okay, for Safaricom, they have to do that. Okay, what's the IRR? Okay, if we invest in this particular potential project, okay, what would be the internal rate of return? Okay. But for the case of the NGOs, okay, Red Cross, okay, that should not be the area, okay, that they're going to be evaluating, okay. But since this is a commercial enterprise, our main concentration for FM, okay, is more towards commercial enterprises, okay. Therefore, evaluation need to be done on commercial terms, okay. If anything, even when it comes to financing, okay, you'll be financed on a commercial basis. Okay, you go to the bank to borrow money. Okay, there'll be no donations in your books. Okay, for Safaricom, there'll be no donation. Okay, for Red Cross, there'll be donations. If anything, that's their main finance source. There'll be grants. Okay, but for the case of Safaricom, okay, another commercial enterprise, it's about determining, okay, what's the commercial returns to be received from us investing in this particular project. Okay. As I mentioned, in the case of the NFP, okay, NGOs, okay, don't forget, we should not use commercial basis when it comes to the evaluation of whether or not the company should invest in the project, okay. As I mentioned, even when it comes to financing of this organization, okay, they're not going to go to the bank to borrow money, essentially, okay. So it's going more towards donation from other participants, okay, from the market, okay, from the economy, okay. They're not going to go to the bank to ask for a loan, okay, no. Okay. They may do so, but if anything, that's not their main agenda. Their main agenda is to, if possible, we are going to be financing from different people. So we're going to be financing us, okay, the government, okay, well wishers along the way, okay. So capital budgeting or investment decision, okay, it refers to the process of identifying, analyzing, and selecting investment projects, okay, whose return are expected to exceed 1 financial year. So the investment decision, okay, also referred to as the capital budgeting decision, okay, is that entire process, okay, that you as a company, you identify, okay, where should we invest our money in, okay, where should we invest the money, okay, in project A, in B, in C, or in D, where do we invest our money? So the first step is you identify potential investments, okay, identify potential investments. So as we shall discuss it along, okay, that is the first major step, okay. Step number one, identifying where should we invest our money in, okay. Should we expand from Kenya to Uganda, okay. Should we purchase a new machine, okay. Should we replace the current machine, okay. Should we build a new should we currently we are doing rentals, okay, or rather we rent, okay, our office block, okay, we want to damage, should we construct our own individual offices as a company, okay. Now these are capital investment, okay, which means therefore you need to first identify, okay, where the company need to invest his money in, okay. And don't forget, every different manager, okay, within the economy, within the organization, okay, will have proposals, okay. If you are the one in charge of operations, you may want to say, let's buy a new machine because the current machines are not doing so well, okay. This board might say, hey, why don't we just build a new office, okay. So, of course, therefore, there'll be competing investments, there'll be competing projects, okay, that will come along the way, okay. So, of course, you as the manager is you to pitch your idea, okay, is you to pitch the idea well, and of course, the board of directors. Don't forget, the board of directors are the one who ultimately are going to decide where the money is going to be put in, okay. So, identify, okay, the valuable projects, okay, where the company can invest its money in, okay. Next, what do you do? Okay, select the investment, analyze it. Okay, so we want to build a new office. Okay, so I'll make analysis. Okay, currently, how much rent do we pay? If we build this new office, how much rent are we going to be saving? Okay, so you need to do the analysis. Okay, of course, therefore, the key part being the key part of analysis is more towards the quantitative. Okay, there's some things that are not quantifiable, okay, but when it comes to the analysis, okay, what really matters is those bits of the projects, okay, that can be quantified, okay. So therefore, you quantify what are the financial benefit to be received if you have to invest in this project. What are the financial costs to be incurred, okay. So that the next step therefore is analysis, okay. Then of course you select, okay, based on the analysis you've done here, okay, we got an NPV of, let's say, positive, let's say 10 million. Is this a good investment? Yes, because it is positive, okay, because you're getting more cash, okay, than what you spend, okay, in present value terms, okay. So select the investment based on the method that you have chosen, okay. That's called capital budget decision, okay. We shall be discussing what are the steps, okay, that you follow when it comes to the capital budgeting process, okay, or the investment decision process, okay. But before we do that, we discuss what are the features, okay? What are the features of the capital projects, okay? What are the features of capital projects, okay? Now, one of them, of course, definitely is that they do involve a huge amount of capital, okay? The initial capital required is going to be huge, okay? If it's only 1,000 you're spending, okay, then that might not be a capital project, okay? That might be a revenue expenditure, okay? Should we purchase pens or not? No, that one is not going to be required, okay? Should you purchase a printer? Okay, if it's only going to cost you 4,000, no, that's not a capital project as per se. Okay, it doesn't mean that the company should not to determine the value to be earned out of it, but essentially, those are not capital projects. So generally, okay, capital projects to a company, to an enterprise, okay, is going to involve huge capital commitments, okay, on the side of the company, okay. And that's why, therefore, it warrants the extra attention, okay, compared to the revenue expenditure, okay. That the initial capital required is quite significant, okay. Most of the time, going quite significant, okay. Of course, involve risk and uncertainty, okay. Because don't forget the potential earnings to be earned, the potential earnings, okay, that might be earned will be into the future, okay. They will be into the future, okay. Now, what that means is that you might invest today, okay. However, the earnings will be received from the investment, okay, accrues 10 years from now. It can happen, okay. For instance, okay, if you were to take the case of the Tal oil, okay, the one that was trying to mine oil, I think in the upper part of Kenya, okay, the Tal oil, okay. So I think they started project in 2012, or 2010 actually, okay. That's when they started trying to seek oil mining. Okay, are they going to get enough oil? No. Okay, I don't think they're going to get enough oil. Okay, so risk is going to be there. Okay, because don't forget most of the earnings. Okay, most of the earnings that we expect to receive from the project. Okay, are not occurring tomorrow. Okay, they occur 10 years from now, 20 years from now. Okay, therefore there's a high risk. Okay, you might not even actualize. Okay, what you're anticipating. Okay. And of course, it's time work, okay, definitely between commitment and the time to earn money, okay, they can measure that, okay. And most of the time they require prioritization, okay. Generally, when it comes to these projects, okay, definitely the company will be having what we call the 5-year plan, the 10-year plan, the 30-year plan, okay. This is what we want to see ourselves as a company in the next 30 years, 50 years, okay. Which implies, therefore, okay, when it comes to the size of investment that you're going to make as a business, as a company, then of course you need to be able to determine, okay, you need to, when it comes to making a decision, let's invest in this project, okay, you need first to determine, is it going to help us in achieving our 5-year plan, our 10-year strategy, okay. So don't forget, it's going to be, when it comes to analysis, okay, of the project, you need to have that connection between the project and your long-term objectives, okay, as a company, okay. In 5-year time, this is what we want to see as a company in, okay, in this particular market, okay. Now, this investment you're making today, okay, how is it going to help you in achieving those 5-year plans, okay? Because if it doesn't, okay, it can be a good investment, okay. But if it does not make you achieve your 5-year plan, your 10-year plan, 30-year plan, then you may want to let it go, okay. It might not be the project for you as a company, okay, because there need to be a very close connection between the plan, okay, between the objective, between the project and you achieving your objective, okay. It's one of the part of the process, which one of the key step, okay, in the appraisal process, okay, which we shall mention it alone. That need to be there even before we actually do the analysis, okay. Before we start doing the analysis, quantifying the cash to be earned, the cost of the investment, first determine, is it going to help you achieve your long-term objective, okay. Most of the time, okay, they're reversible, okay, most of the time. Well, that means that once you make the decision to invest in the project, okay, then you may not be able to reverse the decision, okay. That once you start construction of the office, then you may not say that half the way of the investment, you decide to abandon it, okay. It might not be the case, okay. You may have in code you force yourself, okay, to complete it, okay. You can't leave the building half complete, okay. If anything, if you do that, then of course there will be laws that may cancel it away, okay. Because sometimes they can have law that tell you, hey, if you don't do the construction within this time period, then we as a county government, okay, you can ask to repossess your property, okay. It can happen, okay, definitely. So sometimes as a company, once with the decision, you have to go until it's end, okay. And maybe if you do that, maybe you may want to reverse it. See, some can be reversed. For example, purchase of machineries, okay, you can reverse it, okay. You can decide to dispose of the asset later on, okay. However, if you attempt to reverse it, then most likely you're going to be ending up losing money, okay. For example, if you have to buy a brand new car, okay, out of the showroom, okay, what happens in case you drive it out of the showroom? Immediately the value dropped by 30%, okay. Immediately to step out of the showroom, this value, even if you go back to the dealership, okay, to get back the money, it is not going to happen. Its value has dropped immediately, okay. So therefore, you may reverse it, but it will come at a cost. Okay, there's some you can reverse, but of course they will come at a cost. Okay, that's what you have here. Okay. And so at the end of the day, okay, when it comes to the investment, okay, when it comes to the capital buying decision, okay, as a company, you have to be quite careful, okay. It might take long, okay, before you decide to commit your capital, okay, because all these steps need to be fulfilled. You need to be confident that this is going to be a good investment for the company, okay. You don't just wake up one day and say that let's invest the money here. No, it has to take time, okay. And even some cases, they need to have approvals, okay. If you're doing a construction, okay, it will have approvals, okay, which might be beyond your control. So there's going to be more capital commitment, there'll be more time commitment, okay, when it comes to these investments, okay. Now, capital rationing, okay, which we shall discuss later on, okay. And let me first go through the steps, okay. Then I'll come back to capital rationing, okay. So the step that we have just mentioned, okay, that when it comes to making the capital budgeting decision, okay, there's some steps that you need to follow, okay, which I think we mentioned. The first one was about the ideas, okay, the relation of the ideas, okay. Someone need to come with a proposal that, hey, okay, as operation manager, I think currently the machine we are using are too old, okay. They consume too much power, okay. Currently in the market, we have more efficient machines, which I think we can explore as the company, okay. So someone need to come with an idea, okay. As the HR manager, maybe there's a new software that we can acquire that can help us maybe doing better recruitment. That's a company investment, okay. So many different managers, they come with a proposal, okay. So the first step is about idea generation, okay, trying to determine the current company problems, okay. What can they be solved, okay. If you want to achieve a 5-year plan, okay, what do we need to do today, okay. So that's about idea generation, the first step, okay, coming up with an idea on where the company might put down its capital in, okay. The next step is about screening of the idea, okay, is about the screening of the idea, okay. And this way we say that if, for instance, the key question you need to ask here in step number 2, okay, is it going to help us, for example, achieve our long-term projects, okay, achieve our long-term objective? Is it in line with the company plan for the next 5 years, for the next 10 years? Okay? Is it in line with the company plan? Okay, because if it is not, then you may want to drop it. Okay, don't go step number 3 if it doesn't help you. If in step number 2, the answer is that it does not help you in achieving your long-term objectives. Okay. Step 3 is now the analysis. Okay, the analysis will come after you've screened the idea. Okay, now in this step number 3, okay, as I mentioned, is about quantifying. Okay, what are the cash to be earned? Okay, what to be the resources to be used along the way? Okay, so what will be the value to be received by the company if you are to invest in the project? Okay, so it's about the trying to determine the different appraisal techniques that can be used. Okay, if you use NPV, what's the NPV we're going to use? If we use the IRR method, what will be the IRR? What will be the payback period, for example? Okay, so this is step of quantifying, okay, and applying the different appraisal techniques, okay, in the project, okay. And of course, therefore, if you use NPV, okay, and we get positive, what do you do? Yeah, it's a good investment. Let's go ahead with it, okay. So go or no go decision in this step, okay. Should we or should not invest in the project? Okay, should we or should not invest in the project? Okay, based on the value to be received. Okay, if it's a good investment, okay, and you have decided to invest in the project, and actually the company has gone ahead and made the investment, has started construction of their maybe the office block. Okay, now the next step is to monitor the project, the progress of the project. Okay. As I mentioned, okay, this is not an investment that is going to take one day. Okay, it will take some time. Okay, if you are Safaricom home fiber, okay, you're not yet there yet. Okay, many years after you started the investment. Okay, so you only supplying 10% of the population. Okay. What do we do? Okay, the investment need to go continue until, for example, you have, let's say, 80% coverage of internet, okay, home fiber within the country, maybe. Okay, that's time to think. Okay, so now we need to monitor. Okay, when we launched the project 2 years ago, where are we now? Okay, what was the plan of the project? Okay, that within 6 months, this way it should be. Okay, within 8 months, yes, this way it should be. Okay, if the company is earning money from the investment, okay, we compare what was the plan, how much were you to earn? Okay, in year 3 we are meant to earn 10 million. Okay, now we're in year 3, how much are we earning? Okay, we're earning only 6 million. Okay, instead of 10 million. What's the problem? Okay, we are not earning as a plan. Okay, the plan to earn 10, now we are earning 6. Okay, what's the problem? Okay, it's trying to evaluate the different, trying to answer that question. Okay, should we maybe put more controls? Okay, there are chances or loopholes along the system. We are losing money. Okay, were we too optimistic at the time of investment, for example? Okay, well, that could be another reason. Okay, maybe we are too optimistic. Okay, at the time of making the decisions. Okay, next maybe be able to determine should we continue or discontinue this investment. Okay, maybe at the time of appraisal, year 2020, the market was doing maybe it was a bit better for us. Okay, but 3-4 years down the line, maybe what we were planning to achieve was not what we actually achieved. Okay, in short, at that point we were over optimistic. Okay, of the market. Okay. And now the reality hits in that, hey, we might never achieve what we had planned for. Okay, so what do? Do we continue or discontinue this investment? Okay, you make an evaluation. Okay, if I continue, this is what I'll be earning, this will be the cost. If I discontinue, this is what I'll be earning today. Then make a comparison. Okay, which of the two options is going to either give me more value or is going to minimize my cost. Okay, because you need to make that decision. Okay, so that's on the investment making decision process. Okay, which your examiner has asked in the past. Okay, a 7 marks question. Okay, asking you to discuss the steps. Okay, that you involve when it comes to making those investment decisions. Okay, let's look for that question because your examiner has asked that in the past. Okay, asking you to discuss these steps. Okay. Any question? I think I've talked too much. Daisy, any question?
No, sir.
No, it's clear.
Yeah, it's clear.
Okay, Sakina, any question?
No, sir.
Okay. So let's look for your examiner. There's a question that your examiner, I think I had just mentioned, had asked you with regard to. Okay. So there's time your examiner asked that question. Those steps, by the way, the one you just described together. Okay. I think it was a 7 marks question. You meant now to discuss them in detail. Okay. For 7 marks. Let me check so that just to draw your attention that they can be asked. Here it is. This is page 11, page 12. Okay, this company is called PV Company. Okay, company called PV Company. So PV Company. Okay, page 11, page 12, part A. Okay, part A. The question the examiner is asking: identify and explain the key stages in capital investment decision making process and the role of investment appraisal in this process. Okay, so the same math question. Okay. So being asked to get to discuss the steps, okay, the one we just discussed, okay, and of course here with the key concentration on the appraisal investment, okay, decision. So NPV, discuss NPV, can discuss the IRR method, okay. So 7 marks. Brian, you can answer that question.
Yeah, I think so.
Okay. I don't want you to repeat, but whether you can be able to answer it, okay, on your own, okay. Those steps you've discussed, okay. So also in more or less they have like 4 steps, but now the third step, okay, the step of analysis, okay, that's we need to explain more now, okay. The step number 4, step number 3, okay, is where we need to have more concentration discussing the different appraisal methods, okay, NPV, IRR, okay, of your choice, okay. Here in this example, the examiner is not making a distinction, okay. So step number 3, you need to have a thorough discussion, okay. Okay. And now let's go back to capital rationing. Okay. Definitely, when it comes to the appraisal of the investment, okay, as a company, you do need to first get to know, okay, understand, okay, first, do you have enough money to be able to invest in the project? Okay, that's the question you need to answer as a company. Do you have money to invest in the project? Okay, because if you don't have the money to invest in the project, then you may want to, in quotes, you may want to perhaps not invest in the project, okay? Because you may end up staying too much as a company, so that you end up diverting resources to the core functions, okay? The investment is not, don't forget, the investment is not so urgent as per se, okay? It of course requires priority, but you may want to consider you don't want to be declared insolvent because of having excessive and unplanned investment, okay? So you have to consider first, do you have money, okay, to invest in the project, okay? If we don't have money, okay, can we be able to acquire the financing from external parties, okay? If are they willing to finance us, okay? Do you have any agreement you have with them? that this machine is going to cost us 50 million. Okay, do you have financials willing to finance the investment, willing to finance the cost? Okay, you have to be able to get that. So sometimes you have cases where you don't have enough money, okay, to invest in the projects. Okay, for example, you can have two investments. Okay, you want to make. Okay, you want to invest in let's say project A. Okay, project A and B. A costs you 10 million, B costs you 15 million. In total, the two require 25 million. What you have in store, the capital you have in store, okay, from all capital providers is 20 million. Okay. Now in this context, therefore, you are in what we call capital rationing situation. You don't have enough money, you only have 20 million. The amount of money you require is 25 million. Okay, therefore you are in capital rationing situation. Okay, you're in a capital rationing situation. You don't have enough money to be able to invest in other projects. Okay, in A and in B. Okay. So costing, okay, is referred to as the costing imposed, okay, is referred to as capital rationing. Okay, the costing imposed is referred to as capital rationing. Now, if this restriction, okay, of 20 million, okay, is out of the company own volition, okay, is the management who have tried to put the restrictions, okay, the company says that we're not going to borrow externally, okay, we don't want to do that. We only want to finance from all our own money, okay. If that's the case, therefore, that the fact that that's soft capital rationing, okay, the restriction is imposed internally. Okay, it is the company, for example, the board, who make this dictation, or they dictate that, hey, we are not going to be borrowing money. We are only going financing from what you have. Okay, and what you have is 20 million. Okay, so therefore this restriction has been imposed within the company. It's the management themselves who have made this restriction. Okay, if, however, this is the total amount available from external parties, okay, then this is exposed externally. Okay, the company would want to acquire more capital. However, the market is only willing to give them, for example, 20 million. They call the hard capital rationing situation. Okay. And we shall discuss around how we appraise in this context. Okay, how do we appraise the case? How do we make the appraisal? How do we determine where we're going to how you're going to invest this 20 million among the project A and B, for example? Okay, so this along we shall discuss this area. Okay, what we call capital rationing. Shall discuss in detail. Okay, how we appraise in cases where we have capital rationing. Okay, for the time being, let's concentrate on how we appraise first. Okay. Now, what might cause a case where maybe the market is not wanting to give you more money? Okay, either because they perceive you as a very risky borrower. Okay, maybe, for example, you have not been paying your loans. Okay, you're a risky borrower. So in case you got to go to the market and ask for more money, the market is not going to give you money. If you owe a bank A money and you never paid money, okay, you have a very poor CRB rating, okay, as a company. Okay, therefore no one is going to give you money. Okay? The market has the money, but they don't want to give you money because you have very poor rating. Okay, if you have a depressed stock market, okay, okay, and a depressed stock market, this is where the market, okay, is suffering. Even currently, I think for most stock markets, okay, this might not be the best time for a company to issue shares. Okay, I want to guess. Okay, why? Because who is going to buy shares right now? Okay, maybe these are going back to normal bit, but generally, okay, before you want to issue shares in the market, you may want to wait, okay, until the market has picked up. Okay, in quotes, if you use that terms. Okay. So if the stock market is depressed, then it might not give you funds. Okay, no one is going to buy your shares. No one is going to buy your bonds. Okay, another case could be in case the government is over borrowing internally. Okay, if the government is borrowing internally, don't forget, if you go to the bank. Okay, you as company A, Safaricom, and you have here the government. Okay, who do the bank give money first? They give the government, definitely. Okay. Which means, therefore, the government comes and compete with you as companies, okay, for the internal finances, okay. So in case you have excessive internal borrowing by the government, then that might not be the best case for the companies, okay. Then definitely in case you have high issue costs, okay. If you have to issue bonds, okay, bonds, all the different financial instruments, okay, that you issue in the market, there'll be cost of issuing them, flotation cost, okay. For example, if you issue shares, okay, you don't need to pay for someone to do that for you. Okay, you need an investment banker to assist you in the issue of shares. So you have to quantify, okay, how much cost, what is going to be my cost, okay? If you have to issue shares currently in the market, okay, what will be my cost? Well, it will be $10 million, okay, just to think $10 million, okay? How much money do I want? Okay, I want $20 million. Is it worthwhile for me to issue this $20 million? It's not worthwhile because the cost is 10 million, the amount you're receiving is 20 million. The cost is half of what you're going to receive. That is not advisable. That's not suboptimal. Okay, suboptimal. Okay, so you have to compare how much was the cost really being carried if I was to issue this particular capital into the market. If the cost is very high, then you may want to avoid. Say, hey, let me just wait. Okay, those investors I wanted to invest in my money in, I'll not invest this year. Okay, the cost is too high compared to the amount of money I'm receiving from the markets. Okay. So as I had mentioned, okay, that what really matters when it comes to the appraisal, okay, and the key step that has, in quote, more marks, okay, when it comes to your exam is the quantification of the cash flows, okay, the quantification of the cash flow, year one all the way to year end, the end year, okay, getting the cash flow for each of the year. Now we have therefore the concept of relevant cash flows and irrelevant cash flows, okay. So here we have the concept of relevancy and irrelevancy, okay. Now, when it comes to the appraisal of the investment, okay, we only consider those cash flows that are relevant. Okay, I think you've done this already in the past. Okay, but we only consider those cash flows that are relevant. If they have cash flows or costs, okay, that are irrelevant, then we don't include them in the analysis. Okay, for example, if you're going to be paying your employees, okay, you're going to be employing new employees. If they, as a company, we go ahead with this investment, okay, the cost of the new employees, okay, is therefore relevant cash flow. We need to include it in the analysis, okay. If, however, you're going to be using the employees you're currently using, okay, so currently you have some employees you have already employed. However, you're not going to employ new employees. In short, you're going to just be diverting the labor force from one department to the other department, from the department to the project. Okay, so there's no any new cost being carried as per se. Okay, because those employees used to be there before. Okay, so the cost of the pay to these employees, okay, it is therefore irrelevant. Okay, it is not relevant. Why? Because you used to pay this employee even before you did invest your money in this project. Okay, so the cost was there even before. Okay, therefore the cost is therefore irrelevant. Okay, the cost of paying the employee is therefore irrelevant. Okay, but in case we do have you employ new employees for the investment. Okay, you don't forget, you know, I used to pay these employees. You're paying them anew, afresh. Okay, the cost to these new employees therefore is a quantifiable cost to the investment. Okay, therefore a relevant cash flow. Anyway, what really matters when it comes to determining the cash flow is whether determining whether cash flow is relevant or irrelevant. Okay, is the concept of incremental and futuristic. Okay, that's the concept. Okay, incremental and futuristic. Okay, so if a cost is going to be incremental but not futuristic, then that's irrelevant. Okay, by incremental means is an increase or a decrease in the current cost or cash flow. Okay, you're either going to be paying more money or going to be paying less money. You're going to be earning more money or earning less money. Okay, that is incremental. Okay, and here by the time incremental is not always increase. Okay, it's both increase and decrease, increase and also decrease. Okay, so it's not just increase. The name seems to suggest is incremental. It's a change in the current status. Okay, if there's no change in the current status, like the example given of an employee, okay, they pay to the employee who used to pay them even before. Therefore, it's not incremental at all. Okay, so therefore it is therefore irrelevant, and also it need to be occurring in the future. Okay, if the cost has already occurred, okay, before you make the investment, then that cost is irrelevant. It must be occurring in the future. Once I make the decision, what's the cash that flows from us making this decision? Okay, not what has already been paid. Okay, before you make the decision, because in case you already paid for something before making the decision, then that's a sunk cost. It's a past cost. Okay, or called a committed cost. Okay, it's a sunk cost. Okay, it's a past cost. Okay, which therefore is an irrelevant cost. Okay. So the criteria when it comes to determining the cash flow is relevant or irrelevant. Is it incremental? Okay, and is it occurring in the future? Clear? Nafisa is clear?
Yes, sir.
Okay. Now, some of the relevant cash flow, okay, which I think we shall come across, okay, as we do the appraisal. Well, the first one is the initial cost, okay. Sorry for that. So one of the initial costs that you'll be incurring, the one of the relevant cash flow which you incur today is the initial capital, the initial cost of the investment. Okay, what that means is that as at year to zero, okay, if you're going to purchase this machine, okay, how much does it? How much do I need to pay for it? Okay, that's the initial cost. Okay, what will be the amount of incurring as I transport, or as the cost of logistics, okay, to bring this machine into the factory, okay, to make it operational. Okay, what are the import duty in case we import this machine? Okay, so all those costs being carried, okay, to bring the asset in its current usable format, okay, is what referred to as, they become part and parcel of the initial capital cost. Okay, become part and parcel of the initial cost. Okay, so therefore they are quantifiable. Okay, and you incur them at that point in time. So the first cost that is relevant is the initial cost. Okay, the cost of the machine, the cost of building that you've been carrying. Okay, the permit cost you've been carrying. Okay, all those are relevant costs. Okay, the cost of construction itself. Okay, all those become a part and parcel of the initial cost, which we do incur as at year zero. Okay. Then if it's a machine, for example, okay, if it's a machine, for example, they'll be called the cost of production, okay, the cost of production, okay, the units to be producing, okay, they'll be carrying, you'll do income raw material, okay, this machine you want to buy, okay, what is it producing? It's producing cement, okay, you as Babu, you want to buy a new machine, produce cement, okay, what is paying the cost of the limestone, the material used to make the cement, you need to buy them, okay. So the cost of producing, the cost of making those units, okay, raw material, labor you've been carrying along the way, okay. The cost of electricity, okay, water that you've been carrying, okay. So all those, therefore, you need to be quantify them, okay. The fixed cost and the variable cost out of you making the decision, out of you purchasing this new machine, okay. The cost of production, okay. Then you have the operating expenses, okay. This machine, for example, okay, it might require, for example, to be repaired, okay, for example, okay. It requires fuel, for example. It requires diesel, if it's a machine that uses diesel, okay. If you use electricity, it requires to be consume electricity, okay. So at the end of the day, okay, these machines will have their own cost, okay, what we call for the operation cost on the machine. Don't forget, if you know about this machine, for example, okay, you will never be incurring those operational cost. If you never made this, you never did the construction of this particular office block, okay, you will never be paying for land rates and maybe, okay, the taxes to the county government, okay, the service costs, okay. So all these costs, therefore, they are therefore attributable, okay, to the investment, to the asset, okay. Therefore, they are therefore relevant when it comes to the appraisal of the investment, okay. Then you have got the opportunity cost, okay. The opportunity cost, okay. Now, what do you mean by this? The opportunity cost we get is the cost that you will be, you may add up, okay, either not incurring, okay, maybe comparing, okay, that if we were to, if, for example, as a company, let's use the case of the employees, okay. The employees you currently use in the investment, okay, in this project, okay, you currently do pay them, or currently they're employed, you have employed them, okay, but in a different department altogether, okay. You have employed them, but in a different department altogether, okay. So therefore, what does it mean? Okay, to me, therefore, if you're going to use this employee in the new investment, ensure therefore you take away the employee from the current operations of the company. It means therefore the earnings of these employees were the employees of this company, they were earning for the company money in some other department, which means therefore if you withdraw them from that other department, the earning they used to make, okay, the earning they used to make for the company is therefore is not, what's the term choose, the earnings they used to work for the company won't be earned going forward, okay. They used to earn for the company, okay. However, going forward, okay, the earnings to the company will be lost, okay. So since therefore there is lost contribution or lost profit, okay, which the company used to earn from the employees in some other department, which has been lost because the employee are now employed in the new department, in the new project, okay, that imply therefore we need to quantify that, okay. Is an earning used to earn, but you won't be earning going forward, okay. So you need to quantify therefore what's the earning that you're going to be losing, what's the earning that you're going to be you have lost along the way, okay. So all the opportunity costs, okay, that occur as a result of making this decision, they are quantifiable and they need to be considered, okay, as cash outflow for the investment, okay, as a cash outflow for the investment, okay. If, for example, is a replacement, okay, you want to replace an old machine with a new machine, okay, you want to replace an old machine with a new machine, okay. In the old machine, it is earned profit for the company, but since now you have disposed of the new machine to buy this new machine, you have lost some earnings from the current machine, okay, from the existing machine, okay. Therefore, the lost contribution, okay, the lost profit, okay, which you earn in the old machine become the cash outflow in this particular new project. You need to therefore quantify them when doing the analysis of the new project. Okay, I hope that's clear. Okay, therefore, yes.
Could you please repeat operating expenses?
Operating expenses. So the cost you've been carrying, okay, just a simple example, assume the machine, okay, which you just bought, okay. This machine will be requiring repair and maintenance. This machine will be consuming fuel, okay. Therefore, the maintenance cost, the repair and maintenance cost, the insurance cost of this machine, what else? What else be carried? So the fuel cost for the machine, okay. Just put them down here. So the cost being carried. First, your fuel cost of this machine, repair and maintenance of this machine. Okay. What else do we have? Insurance cost. Okay, this is an example of operating expenses. Okay, what are the costs you incur? Okay, to just have the machine or to have the project running continuously, running smoothly. Okay, I'll call therefore part of the fuel cost. Okay, part of the operating expenses. Okay, they are not part of the production cost. Okay, as per se. Okay, but they are more of indirect costs actually. If anything, but they are more of indirect cost. Okay, which I think you have discussed in the past. Okay. Example, fuel cost, repair, insurance cost. Okay, don't forget, I used to pay for this before. Okay, don't forget, if you need to compare before and after. Okay, by the way, when it comes to analysis, it's comparing before and after. Okay, if there was some costs you are incurring before, okay, and even after you've been incurring them, then those are irrelevant. Okay, so if you used to pay for fuel cost, the same thing you used to pay for the old machine, then therefore irrelevant. Okay, but here is about if this is a new investment altogether. Okay, you have quantified the fuel cost, for example, repair and maintenance, insurance cost, okay, such things. Marketing cost maybe, okay, advertising, customer care, okay, rent in case you're going to be operating in a new, if the factory is not yours, okay, you don't own it, okay, so therefore you are leasing out the factory or the warehouse, okay, all those costs therefore they're quantifiable. Clear? Well, that was a second.
Yeah. And I have another question. So you say that if the machine required, if the before and after is the same expense, what if there is an increase in the fuel expense?
Yes.
So do you recognize the increment and the increase or the full amount?
Okay, so if, for example, in the this is done for this before, we used to have machine A. Now you're going to be having the new machine. Let me call that new old. Yeah, so that it becomes more relatable. Okay, this is the old machine. There's a new machine. So in the old machine, okay, we used to pay maybe cost of electricity to use to operate the machine per year to be, let's say, 1 million. In the new machine, it's more advanced. Okay, therefore it consumes less. For example, it consumes around 0.8 of a million per year. What is going to happen that year, okay, what is quantified, what is going to be relevant, okay, when it comes to the analysis of this new machine is a decrease, because this is fuel cost used to pay before, okay, of 1 million. Therefore, the saving therefore is equal to 0.2 of a million. When it comes therefore the analysis of the machine, you don't consider 0.8 million, you consider only the decrease of 0.2 of a million. As the saving the company will be earning out of fuel cost, okay, if the company was to accept this new machine. Clear, Sakina?
Yeah, so 0.2 million is the incremental cost.
Is the increase okay, the cost for the saving is an incremental saving now this time around.
Yeah.
Yes.
Okay.
Yeah, okay.
So could you please explain opportunity cost?
Opportunity cost is what is going to be the foregone benefit the company could have earned, okay, if they didn't accept this investment. Okay, that's called the opportunity cost. Okay, an example could be, okay, let me just use the old and the new machine. Okay, this example, let me customize it. Okay, so if, for example, the company is going to be using the employees currently employed by the company, okay, so the current employees of the company, they currently operate in the old machine, okay, then we want to use the new machine, okay, we consider what the salary used to pay, what's the earnings, okay, of them, so the contribution, what's the contribution these employees used to make for the, used to earn for the company, okay, that's the employees of the company, don't forget as a company as well, they'll have you make, you do that analysis, okay, but currently, how much do we, because you employ the employee so that there's a company, they're getting the employees to be making product for you. So they earn for you as a company. Okay. So for example, if the amount you used to earn, okay, from the employee, okay, from the work they're doing, okay, let's say per annum, or let's say $2 per, let's say $20 million, okay, so the amount you used to earn from the employee. If now you're going to be diverting, okay, these employees, okay, from the old machine to the new machine, okay, you're going to take these employees, okay, from the old machine, okay, to the new machine, okay, what happens is that you going forward, you won't be earning this 20 million because you have taken the employees from the old machine into the new machine. Therefore, when doing the analysis of this old machine, you have to determine how much was the lost amount of how much money did I lose from the old machine since I've now deviated the employee from the old machine to the new machine. This is 20 million lost contribution, okay, which you could be earning, okay, if you had to continue operating the old machine. But since you now use the new machine, you have lost this 20 million. This is what we call an opportunity cost, which you need to quantify in the new machine. Therefore, the new machine, you have to consider that I've lost 20 million, okay, as a cash outflow. Therefore, when analyzing the new machine every year, you have to quantify this 20 million which you have lost, which you could have earned if you continue using the old machine. Clear, Sonia?
Okay, thank you.
So that's on relevant cash flow. Then you have the case tax you pay if you make profit. Don't forget you have to pay tax. Okay, so tax you pay on the profit that you have earned. Okay, if for instance, okay, the new machine. Okay, so this is old machine. This is the new machine. If in the new old machine, the number of employees required were, let's say, 10 employees, okay, but this new machine is more advanced, therefore it is more automated, and so that you require only 6 employees. Then the question is, what do you do with this extra 4 employees? You got the scenario. In the old machine, the total employee required to operate the machine were 10. Now, in the new machine, it's more advanced, so you only require 6 employees. The question is, what do you do with these 4 extra employees? Brian.
You'd have to lay them off.
You have to lay them off, isn't it? Okay, most of the time, you'd have to lay this employee off. But now the question is, do you just chase them away without anything, in quotes?
So you have to give them like severance pay or something.
Yes, that's the thing. You have to pay them. Okay, you have declared them redundant. This employee have been declared redundant. But however, you can't just chase them away. You have to pay them. Okay, their dues. Okay, maybe you pay them maybe 3 months salary. I don't know, depending on the agreement you have with them. Okay, but since now these 4 employees, okay, you have to pay them off because you don't require their service. Okay, under the new machine, for example. Okay, therefore you'd have to pay them final or what call their dues. Okay, for their final dues. So therefore they're going to pass off the payment you're making because of making this new investment. Therefore, you have to consider in year 1, okay, the amount to be paying to these employees for declaring them redundant. Okay, therefore, pass off cash outflow for the new investment. Okay, don't forget this. If, for example, you pay them, let's say $1 million, okay, dollar for that particular for laying them off. Okay, therefore they have to consider for this $1 million as a cash outflow. Okay, when analyzing this new investment in year 1. Okay. Therefore, among the cash flows to appear in year 1 under the new investment is $1 million cash outflow. Okay, don't forget you will not have paid this $1 million if the employee were to continue. If you were to continue with 10 employees. Okay, that's why therefore this redundancy payment is therefore part of relevant cash flow, because if the employee were 10, There will be no employee who has been declared redundant. Okay, but now since you only need 6, they have to let go 4 employees, and you have to pay them. Okay, for let them go. Okay. Then you have got the residual value. They will call this so-called the scrap value, also the so-called disposal value. Okay, assume that you bought this machine in year 2020, and now in year 2030, that is 10 years later. Now this machine has you can be able to dispose it off in secondary market. Okay, it is possible to sell this machine off in secondary market. Okay, if it is possible, okay, this machine you sell it off and get let's say 500,000. Okay, therefore there is 500,000 to be earned in the year 2030 because therefore cash inflow in year 2030. Okay, therefore in doing the analysis, therefore in year the year 2030, you have to quantify the potential amount to be earning from the disposal of this particular machine. Okay, therefore this is a cash inflow in year 2030. Okay, then you have the cost of decommissioning. Okay, this is
Excuse me, sir.
yes.
Could you please repeat the residual value?
Residual value.
Yes.
Okay, so if, for example, okay, this is an investment. Okay, let's take the simplest example. Okay, it's a machine. Okay, which you have bought in year 2020. Okay, we bought this machine in year 2020. Okay, and now at the end of its life, okay, assume the end life is 2030. Okay, at the end of the life of machine, year 2030. Okay, you have to consider: is it possible as a company in year 2030? Okay, we can earn some money from its disposal. Okay, if it is possible that at the end of year 2030, it is possible you go to the market and tell the market, hey, I bought this motor vehicle 10 years ago. Okay, the market can say, yes, we are willing to pay for something for you or something to you. Okay, if the market is paying you, for example, 500,000, then okay, therefore this give me a cash inflow in the year when you receive it. In this case, year 2030. So therefore, in year 2030, you'll be having a cash inflow over and above all the other cash flows. You need to quantify a cash inflow equal to 500,000 to be received from the disposal of the asset. Then, clear, Nafisa?
Yes, sir. Thank you.
Okay. Then you have got the cost of decommissioning. Okay. Now here, I think I was giving an example of if you're involved in mining. Okay. So if, for example, you're doing mining, okay, you're Baburi, for example, okay, you can't just leave open holes all over, okay, as you mine, okay, you can't just leave open holes. You have to make good the environment, okay. You have destroyed the environment, okay, as you mine, as you go ahead with your project, okay. Therefore, the cost you'll be incurring, okay, to make, I don't know, make parks, okay. I think Baburi in Mombasa, they've done that, okay. So they make park, okay, out of those areas where they have destroyed the environment. They try to rehabilitate the environment, in quote, okay. So the cost of incurring, okay, to make good the bad you have done to the environment is called cost of decommissioning, okay. And why do you incur it? Because in the first place you didn't invest in the project, okay. So the cost of incurring to make good, okay, for some of so to make good for the environment you've destroyed, okay, can therefore part of the decommissioning cost, which of course you have to therefore incur, okay. Even in construction, okay, so you have, for example, okay, you can't just leave, okay, rambles all over, okay, after you've done the construction, you have to clear them off, okay. So therefore, the cost of incurring as you clear off, as you make good, okay, try to repair the environment, okay, is also part of the decommissioning cost, okay. If you mine oil in the open sea, okay, so if there will be any oil spillage, okay, you have to clean the environment, you have to clean the sea, okay, as a oil mining company, okay, you can't leave the sea like that, okay. If there's oil that you have that has spillages all over, okay. So the cost of incurring to try in attempt to repair the environment is called cost of decommissioning. It's like you're trying to add the project, okay, the cost you incur as you add the project, as the life of the project comes, the life of this investment comes to an end, okay. Therefore, those are costs, therefore, that are going to be relevant, which we ought to consider. And lastly, we have working capital, okay. Lastly, we have working capital, okay. The net working capital required, okay. You have to determine, yes, this is going to be a new machine. However, this machine requires raw material. I will need to be investing in my customer from the sale I'm making from this unit. Okay, payable suppliers will be investing in my company from my investment. In short, how much money is it required, okay, for you to kickstart this operation, okay? You have the machine with you, but you have no, if you have machine and no investment towards working capital, then how do you expect therefore to run this machine? It can't. If there's no fuel you want to invest in it, okay, if there's no raw material, okay, if there's no sale you make on credit maybe, okay, then sometimes it can be operational. Yes, you have the machine with you, but how is it being operating, okay? How much money do you want to invest towards working capital, okay? You must put some money down, okay, to purchase raw material, cost of production, okay, invest in your customer. So at the end of the day, you need to invest towards working capital, okay? Therefore, the amount you need to invest toward working capital, okay, the year when you invest this working capital, there will come therefore a cash outflow. Okay, don't forget you are investing, you are paying, okay. So in case you have a positive working capital, it means you are paying, okay. If you have a negative working capital, it means you are receiving, okay. Okay, for example, in case you scale down the operation, okay, you reduce your working capital, for example, okay. Therefore, in that context, therefore, there will be a cash inflow at the year when you scale down the operation. If you're going to be increasing the operation of the company, you need to invest towards working capital. Therefore, the amount you're investing towards working capital, the extra, for example, okay, therefore, can therefore cash outflow, okay. Okay, therefore they can afford a cash outflow. So the incremental working capital, okay, the year when you invest towards working capital, therefore you quantify it as a cash outflow, okay. The stock, the work in progress, okay, the debtors, the creditors, okay, all those they can therefore part and parcel of analysis. Then there could be years, okay, when it comes to working capital, if by the year 2030, okay, like this investment we were discussing before, okay, that in year 2030, that's the end of the investment, okay, that's the end of the project. Now already have invested towards working capital. For example, raw material, okay, you have raw material already. What do you do now that this is the end? You have stock. What do you do? Okay, you are a retailer. Okay, now we are now into year 2030. Okay, this is the end of the investment life. What do you do with the stock you have at hand? Let me just get someone just to get your opinion. Anita. Anita. Yes, now in year 2030, what do we do with stock? In year 2030, what do we do with stock? You're far from your mic, Anita.
Sorry, I have a cold. I can't really speak very well.
Oh, okay. But we can hear you. To speak like you are doing right now.
Could you please repeat the question?
So the question is, in year 2030, I'll that a very simple example. You are a retailer, okay? So today you have invested towards stock to the tune of, let's say, 1 million, okay? That's today. Now in year 2030, this is when the project comes to an end, okay? What do you do with this stock you bought of 1 million?
Can you resell it? Can you sell it?
We didn't hear you very well, Anita.
I'm saying, can you sell it?
Yes, you sell it, of course. Okay, therefore, in the final year, thank you, Anita. In the final year, if you have any previous investment towards working capital, you're going to be in code like selling it off. You recover that working capital. Therefore, in year 2030, this is going for a cash inflow of 1 million. Okay, therefore, in year 2030, you have to consider this is previous working capital investment is a cash inflow of 1 million. Okay. So be careful by the working capital. You can make a mistake there. Okay. So in the year when you inject the capital, that you inject working capital, therefore that's a cash outflow. Okay, therefore that's a cash outflow. Okay, in the end of the life of the investment, okay, therefore become therefore the last one become therefore a cash inflow. Okay, at the end of the life of the investment, year 2030, what do you do with that stock? You dispose it off, get the money. Okay, therefore become therefore cash inflow. Okay, that's towards working capital. Okay, that's towards working capital. That the money that you did invest in the projects become therefore a cash inflow. Okay, so get to know that. Okay, at the point of investment is a cash outflow. At the point of release, when, for example, when the life is coming to an end of this investment, okay, then we are going to therefore be getting that money. Okay, become therefore a cash inflow. Clear? Nafisa, is clear?
Yes, sir.
Okay. So be very careful with working capital, because I know you there. That's where you have mistakes. You may have getting mistakes there. Okay, that at the end of the life of the investment, you're going to be recovering the working capital. So if you did invest 1 million in year 2020, therefore in year 2030, okay, the end of the life of the investment, we need to recover that working capital. Okay, we recover working capital. Then there's some cash flows which essentially they'll be irrelevant. Okay, that is, we don't need to consider them when it comes to the appraisal of the investment. Okay? However, you may have them. Okay, however, you may have to ignore them because the examiner is going to give you. Okay, one of them becomes the interest charge. Okay, the interest charge. If, for example, the company was financed through a bank. Okay, you did use a bank loan to finance yourself. Okay, therefore every year you have an agreement with the bank that, hey, I took 1 million from you, and I will pay 10% of the amount I borrowed from you. Therefore, there will be interest charges, okay? Which of course, therefore, the interest you're paying is because you did borrow the money, okay? Therefore, it's seen therefore to be relevant cash flow, okay? And if anything is relevant, okay? This cash flow is relevant. Why is it relevant and not relevant, okay? Because you did borrow this loan, okay, to finance the investment, to buy this machine. So why, therefore, they have interest charge, therefore, irrelevant cash flow? They are irrelevant because we do consider them when it comes to getting the rate of return, the discounting rates. Okay, when it comes to getting the present value of cash flow, when it comes to getting the present value of cash flow, the interest charges are part of the discount rate. If the money came from shareholders, okay, if the money came from shareholders, the dividend you pay the shareholder, okay, therefore should not be considered when appraising the investment. Why? Because it's part of the R. The part of discounting rate. Which means, therefore, in case you do subtract the interest rate from the cash flows of the project, it means you are double counting for them. Okay, why? Because all the different return to the capital providers are taken into account by the discount rate, the R. Okay, the rate you shall be using when you get the present value of cash flow. Therefore, do not subtract from the cash flows of the project. Why? They're taken care of through the discount rate. Okay. If you make you shall be carrying for market research and
Sir,
yes.
could you please just repeat what you said last, that you are not supposed to deduct from something?
Okay. So you have said that the interest you pay, if for example the bank gave you finance, okay, to finance the project, okay, the cost of the project, the cost was, okay, let's see. Okay. So the cost of the I'm not sure what's happening to my screen here. Not sure what's happened to my screen here, but anyway. So if, for example, the cost of the investment was, let's say, 2 million, okay, and the bank gave you 2 million, the entire 2 million. Let me see if this can help me out. Okay, so assume, let me just double this. Okay, I'm sure what's happening here. So see the cost of the investment, okay, is 2 million, okay. You go to the bank gives this 2 million at a cost of 10%, okay, and therefore every year you're meant to pay to the bank 200,000, okay, that's the amount you're meant to pay to the bank, 200,000, okay. However, what you say that even though this cash flow, okay, you'll be paying this interest of 200,000 because you borrowed the money to finance the cost of the investment, okay, we don't subtract it. Why? Because this 200,000 is taken care of by the discounting rate, okay. When it comes to getting the present value of cash flow, we use what we call a discount rate, okay. Now this 10% is part and parcel of this rate you'll be using here to discount the cash flow, okay. That's what I was saying, that hey, do not therefore subtract this 200,000. Why? Because the 10%, this 10% here, is part of the discount rate here, the R%, one you'll be using to get the present value of cash flow. Okay, because if you do subtract here 200,000, and then the 10% is part of this 10%, is part of this R%, then you're double counting for it. Okay, you're subtracting it twice in quote. Okay, therefore we don't subtract the interest charges. Okay, and the same applies also to the case of the dividends. Okay, the dividend also, the rate of the dividend, the cost of equity, okay, is part of the R% here. Clear?
Yes, thank you.
Then you have the cost of research. Okay, now here, some kind of company where they make a decision, hey, we don't want to, we might not be the best when it comes to doing the market research. For example, if we as Unilever launch this new product, okay, what is going to the market? Is the market going to accept it? Is the market going to buy the products? Okay, maybe the market might buy or not buy, but you want to you want to ensure that let's get the expert, okay, to assist us in doing the research, okay. So if you're going to have research, okay, you consult market research companies, okay, help you out in getting to understand the market, okay, whether this new product is going to be received by the market well, is the market going to be poor, okay. So you may want to consider, okay, what's the cost to be carried, okay. However, that cost in paying to this market company, okay, is irrelevant. Why? Because whether the market, whether the researcher comes back with a positive report or a negative report, okay, it doesn't matter. You have to pay them, okay. If they come up with a positive report, then that's okay, therefore going to make you want to invest in the project. If they come up with a negative report, okay, what does that mean? It might mean that we don't want to invest in the project because hey, they're telling us that this is a very poor product for us. The market is not going to receive the product, okay. However, do you pay the money? Yes, you pay them. Whether you invest or you don't invest, you pay the money. Okay, therefore that's already what called like sort of is a cost that is already committed. Okay, it is not going to be influenced by the decision. Don't forget the cost for it or the cash flow for it to be relevant must be influenced on the decision, must be incremental. Okay, must be.
Excuse me, sir.
Yes.
Something is wrong with my network, or yours. You're cutting off a little bit, like your speech is not clear.
Okay, can you hear? Can you hear me from your end? What is this?
Yeah, now we can hear you.
Yeah, I think maybe my net was not behaving well. Okay, so I'll say that's one of the costs you will be carrying is the market cost. Okay, I'll say that if you're going to be hiring someone who's going to be doing analysis and is going to do some market research on your behalf, okay, for example, okay, you want to determine whether you should launch a new investment or not, okay. It does not matter whether they are going to give you a positive or a negative result, okay. It does not matter, okay. They will be, okay, or you have to pay them, okay. I'm not sure what's happening with my internet today. It's going up and down. You can hear me?
Yes.
Can you? Okay. So as we're saying, so don't forget when it comes to the research cost, okay, the consultants cost, you have to pay them. Okay, you have to pay those researchers whether they come up with a good report to you or a bad report to you. You have to pay them. Okay, therefore this decision therefore is beyond the control. Okay, it's beyond. Let's see. Okay, therefore it is beyond the control. Okay, it's beyond the control of the. It's not based on you making the decision. Okay, it is not based on you making the decision. You have to pay the researchers whether you invest or you don't invest. Okay. In case there'll be fixed costs, okay. In case there'll be fixed costs, okay, which you do incur, okay. Therefore, those fixed costs also therefore are they are therefore okay irrelevant. Okay, those fixed are therefore irrelevant because they are fixed. Okay, they're not incremental. Okay, you just remain where you are before. Okay, therefore they're not incremental cost. Okay, therefore those fixed costs therefore are therefore irrelevant. Okay. But in case the fixtures are increasing, okay, if the fixtures are increasing, then the increment of fixtures, therefore, is relevant. Okay, therefore, you ought to consider it when appraising the investment. Okay, clear. Then you have the cost of current assets. Okay, if already have some other assets you bought 2 years ago, 3 years ago, therefore, how do they influence this decision? They don't. Okay, those are sunk costs. You have already paid for them. Okay, therefore, they are therefore part of irrelevant costs. If you have what we call overhead costs, okay, these are overheads. Okay, these are costs incurred elsewhere. They are being allocated to the department to this particular project. Therefore, they also therefore irrelevant. So any cost that is allocated, therefore, is also irrelevant. Okay. Then you have the what we call accounting depreciation. This is accounting. This is loss of value on asset. There's no in actual movement of cash. Okay, therefore this is a cost that is non-accounting. Okay, not non-accounting, non-cash flow. It is non-cash flow. There's no in actual cash movement. Okay, depreciation. You have depreciation of 10,000 per year. It doesn't mean that you're paying 10,000 per year. No. Okay, it's simply an accounting concept. Okay, that you're having on case of depreciation. Okay, the loss of value of an asset. Okay, it's an actual loss of value of the asset. However, okay, when it comes to the value, you're touching on the loss of value. Okay, in itself, it is not relevant. Okay, there is no in actual cash movement because of the depreciation charge on that particular asset. And I think I already mentioned the case of the dividend. Okay, it is taken care of by the discounting rate. Okay, the R%. Okay, so all the different return you pay to the capital providers, the equity shareholders, the debt holders, the bank loan, okay, they're taken care of by the discount rate, the R%. Therefore, all those return to those provider of capital, therefore, they are therefore considered in quote to be irrelevant. Okay, but they're relevant, but they're taken care of by the R% here. Clear? Question? What's happening?
Just go through the allocated costs.
Allocated costs. Okay. Yeah. In the case of the overhead or the costs that are allocated, okay, as I had mentioned, these are costs that most likely have been incurred elsewhere by other department. An example, the cost of the CEO, the CEO's office, okay, the office called CEO, okay. And now what happens is that this cost is going to be allocated to the department. For example, every department takes a share of the CEO's office cost, okay. However, don't forget, this was a cost that was incurred by the office of CEO, not by the machine, not by the operation, the direct operation of the machine. Okay, which means therefore, if there be any cost allocated, if there be any overhead allocated on this particular project, it is therefore irrelevant. Why? Because this was incurred elsewhere. These costs are incurred elsewhere, not by this machine. So therefore, we consider them as therefore irrelevant costs. Okay. So because they're not for whether the CEO is there or not there, okay, the production has to continue. Okay, it is not that if the CEO is not there, this production stops. No. Okay, if you have to compare with the workers, the pay to the workers, if the workers are not there, then there's no production to occur. If they're on strike, there's no production to occur. But if the CEO is not there, production still continues. Okay. Therefore, those are therefore part of other costs that are not being incurred by the machine directly, but incurred by other departments. Only they're being allocated to this particular department or machine. Clear?
Yes, thank you.
Okay, great. Okay. So that's on.
Sir,
Yes.
could you please repeat interest cost?
Sorry, repeat on?
Interest cost.
Interest cost.
From the previous slide.
Okay, interest costs and the dividends, okay, these are returns you're paying to the providers of capital, okay. The interest costs you're paying to the bank, for example, the dividend you're paying to the equity shareholders, okay. So you're trying to say that these interest costs, as well as the dividend, they're cash flows you pay because you did obtain money from this provider of capital. Therefore, they are therefore part and parcel of the cash flows which you ought to consider. However, they are considered for by the discounting rate, okay. By the rate we use to get the present values, okay? They are considered for by the discounting rate, okay? What implies therefore, we don't therefore need to subtract them among the cash flows, okay? As you could find the cash for year 1, for year 2, for year 3, you don't need to include them there. Why? Because the R, the discount rate, okay, is therefore is what is the rate to is the this R% includes the interest cost and the dividend cost. Okay. Therefore, if you're going to therefore subtract the 200,000 here, like you're just given, okay, then we shall be accounting for them twice. Because here already the R% here includes this 10% here. Okay. Therefore, we ought not to include this 200,000 therefore. Okay, because this 10% here, the discount rate includes the 10% here. Clear?
Yes.
Okay, great. Okay. Any other question? Any other question? Okay, if there's no question, then let's meet at 11:15. We pick from there. Okay, we pick from there. Okay, see you there for 11:15. Yes, yes.
I have a question, but it's not relating to this. It's something else. I wanted to know that what's the difference between accounting profit and economic profit?
I was doing economic profit. Okay. Now, when it comes to the economic profit, what normally do is that you charge what we call it's like you subtract the what we call the return the different providers of capital will give you financing you. So like the normal profit, however, you subtract the return you meant to be paying to the provider of capital. Okay, so it's like, for example, the profit, the normal profit. Okay, normal profit. Not sure what's happening to this. Okay. Is this? Okay, so it's like the normal profit, for example. Okay, profit. Okay, accounting profit minus. Okay, so therefore accounting profit. Accounting profit, I think that one you know, that one you know already how to get it. Okay, so the economic profit. Economic profit. Okay, big one, for example, the profit, accounting profit, okay, minus what we call an implicit charge on the implicit charge on the capital, on capital. Okay, for example, here we have different capital providers will be equal to the minus the dividend. So if, for example, financing, the interest, the cost of capital to the different provider is, let's say, 10%. Therefore, 10% times the money that obtained from all the different capital providers. Whether you pay the interest, you pay the dividend, you pay preference shares, it doesn't matter. So again, we therefore be charging an implicit charge on the capital you obtained from the different provider of capital. Okay. So if the amount of money you have is 10 million obtained from this provider of capital, then it'll be the profit you made. Okay, let's say 10 million. Okay, minus 10% of the 10 million. Therefore, your accounting profit, therefore, will be therefore 9 million. Okay, obtained from the accounting profit minus an implicit charge on the different capital you have obtained from the different providers of capital, whether you paid them or not paid them. Clear? That was Nafisa.
Not really. I got confused.
Sorry, I didn't get you.
I got confused.
Where do you get confused? Right now or where then?
On the charge on capital. Like, what did you mean there?
Now, charge on capital is not an actual charge on capital as per se, because if, for example, you have the equity dividend, okay, maybe for the interest is very explicit because interest you pay, okay, that way. But in case, for example, you have equity and they don't require dividend, okay. However, we assume that you have paid them whether they require or they don't require. So all the different provider of capital, okay, debt holders, equity shareholder, private shareholders, whether you pay them or you don't pay them, we make an assumption. You pay them, you must pay them, okay. Therefore, what remains after you pay them is what we call the economic profit. Is that better?
Oh, okay.
Yeah. This is implicit. Implicit means that it is not must to be explicit. It's not must to be an actual payment. Okay, we make an assumption that you as a company you pay all the different provider of capital their return, whether they want it or they don't want it. You pay them. Okay, it's not as you're paying them, but you want to determine if we are to pay them, how much would remain to the company. That's called therefore the economic profits.
And the accounting profit is the actual, like what you minus.
The actual profit, you normally get it. The actual profit, you normally get it. Okay, the sales minus expenses. That way. Then more. Yeah.
Thank you. And another question. What is prior charge capital?
What is?
Prior charge capital.
Oh, prior charge capital. Oh, okay, that's a topic we have not discussed right now. Okay, we shall discuss it later on. But let me just make a mention. Prior charge let me just make a mention. Prior charge capital, these are provider of capital who rank before the shareholders. Okay, in terms of their payment of their payments. Okay, they rank before the shareholder. They get paid first before the shareholder. Okay, before the shareholder can pay any dividend, they need to pay first their dues. They're called prior. Okay, as the name suggests, it's prior. They get paid before the shareholders.
Okay, thank you.
Okay, fair enough. Okay.
Sir,
Yes.
on this,
Mm.
is it the same as
Same as? Oh, Sakina, we lost you.
Sir, can you hear me?
Yes, can hear you now.
Is it the same as preference shareholding?
Preference is an example of a prior charge capital. Okay, so prior charge capital includes the debt, includes in case there's some grants you need to pay. I don't know, in case there are grants here. Preference share capital. Preference share. So preference share capital is part and parcel of prior charge capital. So it's not synonymous, but it's part of. Okay, it's an example of a prior charge capital.
Okay.
Okay, see you at 11:15. Don't forget to sign in case you're not signed.